One of the unlikely inspiration actually for this talk is an episode of Seinfeld. And you might think, what does Seinfeld have to do with successful investing? And it becomes even more baffling because the hapless hero of the story is George Costanza. And George, in one episode, concludes that his entire life has been a disaster. Every single decision he's made has been wrong. He's unemployed, living with his parents. Therefore, he thinks that by changing his inclination and doing the exact opposite will lead to successful results. Now, I actually think most retail investors would be well served by this advice. For some reason, we have this huge dichotomy with many people. The way they think in terms of their normal life and the way they think about their assets and their stocks can be radically divergent. So I want to give you a few practical tips that I would recommend at least. First, as far as don'ts. Don't invest looking backwards. Quite frankly, this is the most common tendency for people when investing, and it makes sense. It's called recency bias. We take what happens in the past and we project it infinitely in the future. So in 2000, if you look at the S&P 500, you think, my gosh, this is the greatest chart ever. I mean, it's 20 years of nothing but basically great returns. So what happens is that investors tend to build castles in the air, stars in their eye. Their expectations become whetted. Basically, virtually every asset manager had record little cash on the books at the time. But in reality, instead of stars in the sky, it's really been a black hole, as we know. So practical tip number 2, don't run with the lemmings. About once or twice every generation, we go stark raving mad. Whether or not it's thinking that tech stocks that have no profits will go to the sky, or that somehow buying and selling each other's homes will make us all rich, the decisions that we make at times are not very rational in these mania situations. And actually, one of my favorite personal indicators that I've used quite successfully is a cocktail chatter index. Basically, whenever I check out a room and the vast majority of people are all doing the same thing, I want to be doing exactly the opposite, basically. That's the likely successful trade. Thirdly, turn off CNBC. Financial journalism, in terms of broadcast financial journalism, is more akin to financial entertainment. It tends to focus on very short-term phenomena, and it creates a high degree of basically panic in investors as a result of the radical swings that take place. Moreover, in terms of financial pundits, it's not likely that you're going to get any long-term advice that's going to be very successful. So all those things are things to avoid, but what do? The most basic maxim of investing is something that almost everybody forgets. It's buy low, sell high. We have a real psychological problem with this oftentimes because we don't want to be part of losers. We'd rather own Apple, some high-flying stock, than something that's just done miserably. But in 2000, as you could see, if you looked at gold, gold was looked at as an awful investment. It had a 20-year bear market. It was down 70%. Nobody wanted to touch this stuff. But this is the most important thing I think I can impart, which is that in finance and economics, there's a powerful force, which is reversion to the mean. If you have years of outperformance, you will likely have years of underperformance and vice versa. Gold has been up over 600% since then. Practical tip number 1. Second of all, think long term. I love talking investments, but the most popular question I get is, Mark, what do you think is going to happen next month, early next year? Quite frankly, I have no idea. It's interesting. Investing is one of those areas where sometimes the crystal ball is clearer the longer you look out. Benjamin Graham once said that basically in the short run, asset markets are a voting machine. The mob rules. Anything can happen. In the long run, they're weighing machines. True value will find itself out. You just have to be patient and you have to take advantage of it. Thirdly, be disciplined. Interestingly, when I hear about discipline in the financial media, it's all about setting tight stop losses, making sure that your losses don't run too much or too far, too significantly. This is actually the opposite of discipline. And moreover, it induces short-term panic in investors. If everybody has an itchy trigger finger waiting to get out of Dodge at the first drop of the hat, this doesn't even allow their investment strategies to become successful over time. So finally, what I would say is that if you think of stocks like you think of socks, that might actually help you out quite a bit. When you go into a department store and you see socks are 30% off, you don't avoid them. If you have a use for them, you tend to stock up. Similarly, what I would at least advise considering doing is if you think you found a truly undervalued asset and you buy it and it gets cheaper, that could be a very good thing. That seems to be a prudent time to consider possibly augmenting that position. So as far as summary, the don'ts, don't listen to the short-term financial hype. Focus on the long run. Try to find real value out there. And if indeed there's a better opportunity to get something at a better price, consider adding to your holdings as opposed to just pulling them out completely. Thanks.